Hello and welcome back to another stock analysis on Stock Market Palantir. Make sure to subscribe and let us know your thoughts in the comments. Now, let's hear from our analysts.
We are diving deep into what is, well, frankly, the wreckage of LVRO Limited. That's Nasdaq ticker LVRO. This company right now really defines distressed equity. As of today, January 2nd, 2026, the stock is trading, and I mean catastrophically, in the 48 to 60 cent range. We're talking an erosion of over 90% of shareholder value since its de-SPAC back in early 2023. And what's just as alarming is the liquidity, or really the lack of it. Daily volume is swinging between a mere 20,000 and 100,000 shares. That's a clear signal that institutional money has fundamentally written this story off. It's a classic case study of a broken SPAC, and it's grappling with regulatory delinquency and a brutal cyclical downturn in the Brazilian ag inputs market.
And I'd argue that valuation isn't a market malfunction. It's a rational reflection of extreme risk.
Exactly. And that's the central question for us today. Is this distressed valuation rationally pricing in an inevitable failure, a zero-sum outcome, or does it present a profound asymmetric turnaround opportunity that's just hidden by all this technical volatility and, frankly, market cynicism? I'm going to argue the latter, that LVRO is a deep value turnaround story, undervalued because the market is focusing entirely on the technical risks while ignoring the very real operational achievements.
Well, I come at this from a completely different angle. The market is rarely this wrong when it's pricing existential risk. For me, the structural risks, especially the failure to meet regulatory deadlines and the inherent flaws in its leveraged financial model, they make this equity an inevitable path toward total value destruction. The price is low because the probability of the equity being wiped out is extraordinarily high. This is driven by deadlines, not by emotion.
I see why you emphasize the risk, but let me offer a different perspective that's really rooted in operational success. The market is fundamentally ignoring the single most critical factor here, the successful ratification of the Recuperação Extrajudicial, the EJ plan, in late 2025. This legal achievement is immense. It addresses 2.5 billion reais, which is, about 460 million US dollars in trade payables. More importantly, it successfully avoided the catastrophic judicial reorganization, or RJ, that took down LVRO's peer, AgroGalaxy. I mean, they secured a lifeline. And then, on top of that, you have the December 2025 transition to CEO Marcelo Peçanha. This signals a necessary, a forced strategic pivot. The company is shifting rapidly from its previous high-risk M&A growth strategy to a defensive stance focused solely on operational efficiency and asset preservation. Peçanha's deep background, specifically in the high-margin crop care division, is precisely the experience they need to stabilize and execute a margin recovery. It's the only way out of this hole.
That's a compelling point on the operational pivot. I'll grant you that. But have you considered the immediate, non-negotiable threat posed by regulatory failure? I mean, operationally stabilizing in Brazil doesn't matter one bit if the stock gets delisted in the US. The company is, right now, past the critical December 29, 2025 deadline for filing its fiscal year 2025 Form 20F with the SEC. This isn't some clerical error. It's a direct violation of Nasdaq Listing Rule 5250C/1. This immediate threat of suspension and a forced delisting to the OTC pink sheets is an existential risk. It is a hard, non-negotiable cliff edge.
And yet, here we are. It's still trading.
For now, only temporarily. That deadline triggers an institutional exodus and the complete loss of marginability for the stock. I also argue the crisis is systemic, not just cyclical. The core strategy, this leveraged roll-up model in Brazil's high-interest, high-inventory risk environment, it was fatally flawed from the get-go. We saw the exact same thing with AgroGalaxy filing for RJ. LVRO's structure was just crushed by the combination of the input price deflation shock of 2024-2025 and those persistently high SILIC rates, which destroyed their working capital. And finally, look, While the EJ plan did address the payables, it came at a toxic cost. It indexed the restructured debt to the IPCA, the Brazilian Inflation Index. This exposes LVRO to potentially catastrophic inflation risk, automatically increasing their nominal debt burden every single time inflation ticks up. That severely restricts their operational flexibility.
Let's focus on the legal achievement of that EJ plan first, because without it, we wouldn't even be having this debate. They'd already be in judicial reorganization, just like their peer. This is a genuine operational lifeline. It secures the company's immediate survival. The EJ plan binds every single affected unsecured supplier, and we're talking industry giants like BASF and Syngenta, to extended repayment schedules, stretching out 2 to 5 years. This immediately removes that critical short-term liquidity squeeze. This structure proves the crisis was solvable and was primarily a trade working capital issue, a mismatch in the financing cycle, not one of fundamental total insolvency. They have secured the runway they need to execute these changes and weather the cycle.
Okay, I agree that the restructuring gives them breathing room on the operating side. But I have to question the long-term cost of this survival. I'm not convinced, because the agreement requires a standardized supply framework across the entire business. LVRO has effectively traded its operational independence for financial survival. They've granted these key suppliers significant leverage over future purchasing decisions, volumes, and potentially pricing, which is going to hit future margins. You can't claim you're operationally independent when your biggest debtors have a direct say in your purchasing protocols.
But that leverage is a function of the negotiation. It ensures that the suppliers have faith the company will survive and continue to be a viable distribution channel for them. It's a necessary condition to unlock the capital.
But let's talk about what they're sacrificing for this so-called runway. The forced proposed disposition of the high-margin crop care assets. This is LVRO's vertical integration unit, historically their most resilient and margin-accretive business line. Selling off your best assets to fund current debt obligations is, well, it's a painful cannibalization that destroys the very unit best suited for future profitability just to fund short-term survival. That smells of desperation to me, not strategic efficiency. You're selling the crown jewels just to pay the electric bill.
You call the disposition cannibalization, but surely it's a necessary surgical excision. If selling the highest margin unit, which perhaps has better asset mobility or cleaner books than the core distribution network, if that keeps the entire larger distribution network alive, isn't that a rational trade-off for corporate survival? If the alternative is the systemic collapse of the whole enterprise via RJ, then preserving the core business by sacrificing a high-margin division is a painful but strategically sound move to get to positive cash flow stabilization faster.
It's a move that limits any future profitability and valuation, even if they do recover. But we're getting ahead of ourselves even assuming a recovery. Let's get back to the most imminent and devastating threat. The NASDAQ delisting risk. The regulatory deadline has passed. This is the primary driver of the sell-off right now. The threat is concrete. It's quantifiable. And the fact that the stock trades with a low beta of 0.41 over the last 12 months, well, that just confirms the stock is completely isolated from any positive market rallies. It's a no-lift risk. This means external good news simply doesn't move LVRO. Only bad news or very specific regulatory news will move it.
That low beta is a sign of deep isolation, yes.
And institutions are mandated to sell non-exchange listed securities. If NASDAQ halts trading or announces the move to the pink sheets, institutional funds have fire sale mandates. This regulatory capitulation risk, not market volatility or commodity prices, is what determines the floor price. And right now, that floor is headed towards zero for most investors. A move to the OTC pink sheets means the loss of critical market infrastructure, no institutional flow, no marginability, no reliable price discovery. That is a death knell for a public equity.
I see why you emphasize the immediacy of the delisting, I do. But I would frame the regulatory failure as a symptom of the restructuring complexity, not a definitive sign of, foundational collapse or fraud. The company explicitly attributed the delay to the complexities associated with the EJ plan, specifically around auditing the going concern opinions and the necessary asset impairments related to that massive trade payable reorganization. This is technically difficult, it's messy accounting and a highly stressed environment, but it is manageable by a competent auditing team.
But if the EJ plan was ratified in late 2025, why is the audit still taking so long? Is this operational complexity Or is it simply mismanagement that's masking deeper, unresolvable issues about the solvency opinion? The market reads this delay as a sign of deeper trouble, not just, complexity.
Exact remains. The successful filing of that overdue 20F is the single clearest near-term catalyst available. It would fundamentally shift the narrative overnight. It immediately removes the institutional threat and forces a re-rating of the stock. It's a specific, verifiable event that management has control over, and its completion would neutralize your primary argument about existential regulatory risk.
Even if they clear the 20F, they still face the IPCA indexing of the debt. Let's not forget that structural vulnerability. They restructured 2.5 billion reals in payables. By indexing that debt to the IPCA, every percentage point Brazil's inflation index rises, LVRO's nominal debt burden automatically increases. It effectively shrinks their balance sheet from the inside out. This places an enormous non-operational tax on the company. They are leveraged not just to the cyclical inputs market, but to the macroeconomic inflation pressures of an entire country. How do you recover margin when your debt service requirement is constantly ratcheting upward, completely outside of your control?
They negotiated an EJ plan because they had to. The indexing was the cost of achieving creditor consensus and avoiding RJ. And you have to remember that while the nominal debt increases, the company's revenue stream is denominated in the same currency and is also indexed to input prices, which typically track inflation over the long term. The key is to grow operational margins faster than the IPCA index. And this brings us directly to the market technicals, which make the upside profound if they can just execute this turnaround.
The short squeeze narrative.
It is more than a narrative. It's a market structure that creates a true powder keg. We have a tiny estimated public float, only about 5.8 million shares, combined with a very high days-to-cover ratio, currently sitting around 5.48. To be clear, that means it would take shorts nearly a full week of the stock's typical trading volume just to exit their positions. Compounding this, the shorts are paying annualized borrow fees between 20 and 30%. It's classified as hard to borrow. This unique combination means that any genuine positive news, the 20F filing, better than expected crop results, even an acquisition rumor could trigger a vertical short squeeze.
I'm sorry, I just don't buy that squeeze narrative. Let me tell you why. Illiquidity is a trap, not a reliable catalyst. The current technical setup is a double-edged sword. The structure, where roughly 95% of the shares are held by affiliates like Patria and the production board, well, it means the free float is extremely restricted. Institutional accumulation is virtually impossible without negotiating private block trades. This means the price discovery mechanism is broken.
But if the shorts are forced to cover, they don't care about price discovery. They care about survival. The lack of float means the supply of available shares to cover is minuscule. It's like lighting a match in a very small closet. Any spark of good news and the lack of space means the reaction is vertical and immediate.
But who are the shorts? The low average volume, around 24,000 shares, means the current short interest, while small in absolute terms, 52,000 shares, it represents high-conviction structural bearishness. This isn't amateur hour. This is sophisticated, distressed money betting on the zero-sum outcome. They are not going to be easily shaken out by a minor uptick. Furthermore, the low volume means that if an institutional holder needs to exit, say because of a pink sheet mandate, they will crash the price further, not lift it. This stock trades solely on event-driven speculation, not on the sustainable fundamentals you need for a recovery that closes that massive valuation gap.
To trade at 0.03 times price to sales, as LVRO currently does, that isn't just distressed, that's deeply cynical. That's the market essentially giving LVRO a pulse and nothing more, implying that 97% of its annual sales will either evaporate or never materialize into profit. It suggests the market is pricing in a 90+% chance of total failure.
And given the regulatory delinquency, the inflationary debt risk, and the systemic failure of the underlying business model, why is that cynicism unwarranted?
Because the operational runway secured by the EJ plan, the new operational leadership prioritizing margin recovery, and the profound technical structure of the thin float and high borrow costs
offer a massive high-reward scenario if, and it's a big if, they clear that 20F regulatory hurdle. The risk is priced in, the upside is clearly not.
The low price is entirely rational. The leverage roll-up model has proven structurally weak against macro shocks. The restrictive inflation index debt burden adds a layer of non-operational risk, and the immediate quantifiable threat of a NASDAQ delisting fundamentally makes this stock uninvestable for most institutional mandates. The move to the pink sheets would wipe out most retail and institutional value, making the equity only suitable for the most specialized distressed funds, which operate on entirely different risk parameters.
The future of LVRO is truly binary. The debate hinges entirely on whether the new management can execute the operational turnaround and resolve the regulatory deficit before the pressures of the index debt and the cyclical market force a full judicial reorganization.
And the problem is that the window for error is zero. The pressure from the index debt and the clock ticking toward delisting means they must execute flawlessly and immediately. The material really does illustrate the massive asymmetry of risk and reward that's defining this stock right now.
If you enjoyed this video, subscribe to the Stock Market Palantir channel for more stock reviews like this. Thanks for watching, and see you next video.